Mr. Groberg, Richard, welcome to Inside Reproductive Health.
Good morning. Happy to be here with you.
You're on because my knowledge of clinical operations goes so far. That's why I have clinical ops guests on, and my knowledge of finance goes so far. As for my firm, I try to shade in all of the parts of the Venn diagram where sales and marketing overlap with finance and overlap with ops, but I'll never be a pure ops consultant. I'll never be a pure finance consultant. And when I reach the borders of the realm, I need to talk to somebody else. And one of those people is you. And I don't know why it took me randomly bumping into you in Las Vegas to think I need to have Richard on the podcast, but I'm glad I did. And I'm glad you're here. So I want to start our segue into the topic with what if you've been helping fertility centers for a while, but what have you been helping them do specifically in the last 2 or 3 years?
Well, in the last 3 years, I've had a couple of different avenues where I've helped fertility businesses. I've worked on 3 transactions where one a fertility practice and 2 fertility related service businesses have partnered with larger groups and private equity, both to get a partial cash out and also to get access to management resources to build more depth for long-term growth. I've also worked with smaller practices that were dealing with selling part of their practice to a doctor, trying to expand. How do I open satellites? How do I buy other practices? And most recently, thanks to you, I assisted a fertility doctor who was a minority owner of her practice uncouple from a corporate roll-up group and become an independent practice majority owned by her.
So of the 3 where you helped sell to a private equity group, were they all private equity? Of those 3, were some of them high net worth individuals? Were they all private equity firms that they were selling to, or were some private equity firms and some were networks backed by private equity firms?
2 of the deals were sales of related companies that were related to the fertility industry, specifically Practice Highway, eIVF, and Reprotech, 2 private equity that was interested in the space. I also helped Boston IVF on parts of its original sale to the British group that was a large fertility network outside the United States, but had no presence in the United States. That one also was ultimately private equity backed, but it was a pretty large sort of fertility roll-up.
So when you get a call that says, "Hey, Richard, we're interested in doing this. I'm interested in maybe I'm interested in exiting, or maybe I'm not interested in exiting. I want to just expand and bring in someone to help with that and scale." What is your checklist? Like, how do you start the process to it's a big elephant. So what is the first bite that you take?
Well, the first couple of steps are a little bit like a health exam for a potential fertility patient. Have to understand the nature of the business, its financial performance, its challenges, its growth opportunities, and what the goals are of the current owners. There are cases where owners want to sell and leave. There are cases where owners want to partially sell but need access to resources that they don't have for growth or the depth of management. So the first step is a practice evaluation. Not a valuation, so to speak, like a formal valuation, but assess the health and the goals of the practice. After that is the part that most people who've never been through this before don't understand. And forgive the terminology, but I've called it the proctology exam on steroids. It's not as simple as you call up somebody and say, "I want to sell," and you give them a couple of numbers and they shake hands and the deal's done. That's where the process starts. They do an extensive evaluation. They do due diligence. They review your contracts. They review your financial numbers and your pregnancy rates and other statistics. And before you're prepared to do that, you have to get your house in order. So there's a lot of housekeeping to be done to prepare for that extensive, painful review to determine, is the price we've agreed to and the terms fair? And am I getting what I think I'm getting from the buyer's perspective? A lot of times these companies, because they're private businesses, aren't necessarily prepared for the scrutiny. terms of expenses that you run through the business that most private companies do that might not remain after a transaction. And I can tell you all kinds of fun stories about unusual things.
Like the business trip to Hawaii. Shout out to Dr. John Fraterelli, because I bet everybody wants to visit Dr. Fraterelli, because, well, that was we took the family and we stayed for 2 weeks, but it was for visiting Fertility Institute of Hawaii. Is that what you're talking about?
And I'll give you some examples, or the car that you expensed, or the fact that you're paying your mortgage and your utilities and all your vacation expenses. And this is an important concept. I had one scenario where a business thought it was making $3 million a year because that's what he saw in his bottom line. But between one-time expenses that aren't recurring and personal expenses running through the business, by the time we got done evaluating it and recasting their financials to properly reflect those non-recurring and what I call private company expenses, he actually was making $4 million a year. And when a buyer is coming in to pay, I'm picking a number for illustrative purposes, 12 times your profits, that extra $1 million of profitability that you can substantiate and prove, in that particular case, put another $15 million in his pocket.
So I've jotted that down because I want to come back to that and get some examples from you. I want to try to go in the order that I'm thinking of you dealing with fertility companies that are in this process. You mentioned the first is assessing their goals. One goal might be exiting. Another goal might be having financial capital to scale or to take over some other business side of the operation. In those two, what are two different paths for those two different goals? Why are those two goals important? Like, why is it important to make a distinction between the two?
Well, if I'm buying a fertility practice, and let's just say it's a 3-doctor practice and 2 of the doctors want to retire and go away, as the buyer, what I'm buying is not as valuable. And obviously the purchase price is not as high as, look, I want to partially cash out, but I can't really compete. I want to expand, but I need money to expand. I need access to other resources, and I'm going to stay, and I'm not going to take 100% cash out. The business is now more valuable to the buyer and will garner likely a higher purchase price. The 2 large transactions I initiated and negotiated for service providers to the industry got a very high valuation because the seller was staying and retained a 30 to 40% ownership stake in the business post-closing. He's got skin in the game. So that's an important distinction, because at the end of the day, the buyer, if they're buying a fertility practice, the buyer is to a large extent buying the engine, and the engine is the doctors running the practice and performing the services.
So it makes sense that if the seller's staying, that the business would be worth more, especially if we're talking about providers and the scarcity of REIs. So it seems like if they're staying, then the practice is worth more. But one perception that I have, or at least it seems, is like the value is in it for those that are exiting. Like, if okay, I'm gonna retire in a year, so whatever happens to the practice, I guess, is the decision of the people taking it over. I'm cashing out all of my equity, and for I guess, what is the upside for a seller staying as opposed to a hold strategy, a long-term hold strategy of their asset and retaining all or more of the equity?
Well, let me give you an example. There's a practice in Utah that recently sold to Boston IVF. One of the doctors was retiring, but another doctor, who's an outstanding doctor, medical director, who's older but committed to stay for 4 or 5 years, and there's another associate there. That practice obviously is more valuable to the buyer because there's continuity there. But to the seller, he's getting now access to this big corporate group who hopefully will provide services better and less expensively than a solo practice can provide, give him access to recruiting and hiring other doctors, give him access to the network, and hopefully 2 to 3 years out, when he is ready to retire, his practice is bigger, it's more profitable, and his ultimate exit will be at a higher valuation. Now, we can now slide into a whole other discussion of whether all the past roll-ups have worked and whether people who've sold into them for some future consideration have benefited or not. The doctors who sold into Integramed, it obviously didn't work. Depending where you were in the spectrum of Prelude, maybe it did work, maybe it didn't work. So doctors who participated in Ovation strategy benefited handsomely when Ovation did a second transaction with another private equity group, I guess a year and a half ago, at a higher valuation. They got a second payday that was successful for them. So there's always the promise of that. It's no different than when a smaller practice that wants to get bigger buys another practice and they merge, and now the practice that got bought is now part of a bigger practice. Theoretically, that could be worth more to that doctor later down the road than if they just gone on their own.
Okay, well, maybe you can be the tiebreaker in something that Dr. Andrew Meikle and Mark Siegel each said in their respective episodes. And I don't want to paraphrase them too much, so I encourage people to go back to listen to the episodes if my memory fails a little bit. Go back to the episodes, but in each conversation asked about building value up until the end. And if I'm paraphrasing Mark correctly, he felt that it's sort of futile to keep adding value to the practice right when it's too late. If you know you're going to sell within a year, and Meikle said, it's you should be adding all the way to the end. And from my vantage point, especially when you're looking at for the case that you just talked about, we got 3 doctors in any given scenario. I'm not talking about a particular case. We got 3 doctors, 2 of them are going to retire, one's going to stay. Well, it seems to me that if that one is going to stay, has a robust brand that's attracting more patients, has a recruitment pipeline that younger staff want to work at, especially younger docs want to work at, that I would want to keep that flywheel moving and invest in that flywheel until I'm out, for the reasons that you talked about. But where do you fall on the debate of it's too late to add value if you know you're going to sell in a year versus keep doing it all the way to the end?
I think that you never stop making your practice a better practice because a deal might not go through. But I also believe, and I have a very close friend in the veterinary business who's been through a number of roll-ups. He operates an independent practice. Everybody wants to buy him. And he's like, I'm 3 years out. When I'm a year and a half out, I need to start preparing so that when I go through that proctology exam on steroids, I'm prepared for the process. But up until the day you close, you always risk something negative happening that gives the buyer an opportunity to renegotiate. So you constantly want to be making your practice more and more attractive, unless you're selling and walking away. But even then, again, one of the mistakes people make, small practitioners and lots of businesses, is they get so focused on the sale process, they lose focus on their business, and suddenly something gets delayed and your volume is dropped by 20% and you're not as profitable, and the buyer comes in at the last minute and goes, things have changed a little bit, we're renegotiating the price. Or I'm having a hard time attracting the doctor you need because your practice isn't doing so well. I mean, if you're walking into a dance and you're looking for a date, I mean, up to the very minute you walk in, you want to make sure that your hair is right and your beard is straight and everything looks good, and there's nothing that gives a negative impression. So that's my view.
Let's pause here for a second. We'll let your dog have it out, and then but we don't need to recap that thought. I'll go into the question. Okay, so I want to get into the proctology exam. Before we do that, I want to talk about it. If Mark Siegel, if you, actually, let me redo that whole piece, because I wanted to do, there was something I wanted to talk about, the proctology exam. I wanted to get into that. It felt like there was one last thing. Maybe there isn't, so I'll go into that.
And there's a very important point I want to make sure we make about the process of selling to a roll-up group of private equity. So please make sure to ask me about, are there any other things
Okay.
that people should be conscious of?
Okay. So I want to ask you about the proctology exam. And if I'm doing Mark Siegel's argument injustice, please listen to episode 100. And Mark, if I'm still doing it injustice, you're welcome back on to clarify at any time. Let's talk about the proctology exam, Richard. What does this involve? I guess that you mentioned that as the second step, but you said before the financial house has to come in order. So let's talk about what that means in order to be prepared for the due diligence.
Well, in a lot of industries, not just the fertility industry, private businesses don't necessarily keep their financials expecting third-party scrutiny. They run expenses through the business that are personal. They may not be tracking non-recurring or one-time expenses. They may be expensing things that in most setups are things that should be capitalized, but for tax purposes, oh, we bought this piece of equipment, let's all expense it in year one. So that data needs to be cleaned up so it's ready for the review from a perspective of a roll-up group or private equity who's going to have banks and financing sources and investment committee approvals to understand the financials. And that all needs to tie to your contracts, your ownership structure. So all those documents and contracts and historical data and financials need to be
meaning
ready
employment agreements, contracts with vendors.
Absolutely. And again, most people, not out of any fault, they're operating private businesses. They never expected this. And all of a sudden, someone's at their doorstep saying, I want to buy you for 12 times your profits. They're not prepared for this. And frankly, they don't have the time often to stop and get prepared for it. And one of my other favorite expressions, if you've never been through this before, you don't know what you don't know about the process that's about to descend on you. It can be consuming and overwhelming. And you need to be ready for what's about to come, because again, it's not so simple as, oh, you're making $2 million a year, I'll write you a check for $24 million. I'll see you at the closing table in a week.
So with regard to the expenses that you said detract from the bottom line that are necessary for that against a multiple are worth that much more if they're added back on. So how do you, is your advice to not account for any of those, to not take any of those as business expenses, or is there another way of accounting for it?
I don't want to give away all the secrets, but there are ways to track it or go back and recast it so that you can track it. And like, for example, again, when a private equity group or roll-up group buys you, they have an independent accounting firm that does what's called a quality of earnings review, which is like getting a 360 body scan. And if you can demonstrate that, hey, these are the expenses that were personal or one time, and here are the receipts, and I can run a report that shows them, and I can provide you the backup to prove it, and in the contract they won't continue afterwards, then you can get credit for it. When I was in the animal hospital business, there were practices that didn't record all their cash, but they have a little piece of paper that would show all the cash that got deposited in the account that never went through their POS system or accounting system. If you can't prove it, the buyer's not going to pay for it. So they're different. I'm not suggesting that you don't do it, but you have to be able to track it and prove it if you want credit for it in a transaction.
All right. I don't want you giving away all the secrets, but you do have to give me a little bit of free consulting right now. Here's an example. So one thing is because I'm not married yet, will be soon, but I'm not yet. And I've rented and living in different cities. I haven't itemized my own tax return. So when I do charitable contributions, I don't have anything to deduct on my own tax return. So one of the charities that I support is Nuestros Pequeños Hermanos. It's dear to my heart. So many people listening have donated when I've asked them, and I'm so grateful for that. And so one of the things that I've done, for example, is I will have Fertility Bridge sponsor a gala, and it will be Fertility Bridge advertising. We'll get the logo on the page and in the pamphlet, and I will invite fertility doctors, fertility clients to the gala with me. So they're at my table, and that's business networking. I don't know though that it's not something you would do if someone else was running the business though, right? Somebody else would pick some different kind of ad. So is the advice that I categorize that somehow differently?
The advice is, if you know now that at some point in the future, you're going to be borrowing money, selling, partnering, track it, take the extra time to track it, categorize it. Even if you put it, like if it's a personal expense and you use QuickBooks, put a class code in for P, so you can always run a report that everything that's P for personal. So if you think now that you're going to have to do this going forward, when I work with new companies, if I know they're going to be raising money, selling at some point, there are things we do from an accounting and tracking standpoint that anticipates the proctology exam a couple of years out, so that you don't have to double back and say, okay, Mr. and Miss Bookkeeper, go back and find every personal expense that you've run through the business and repost it with a code, so that when we get to that point, you can prove it.
There's a book called Built to Sell, and I haven't read the book, so I'm not necessarily recommending, but if the audience is curious enough, we can link in the show notes. The book's called Built to Sell, but I believe the value proposition is to build your business as though you're going to sell it, regardless of whether you do or not, it is a business that someone would want to buy. And that seems like a tenet of that, having your books categorized in such a way. So
it's a good book. And again, that is good advice. If you've anticipated it, you will save a tremendous amount of time, aggravation, money, and not getting distracted from continuing to manage your business by having to double back and figure all this stuff out at a later date when you're ready.
When you're helping fertility companies get their financial house in order, what are some of the main booby traps, or the most common booby traps that you see when you're taking the P&L against the income statement, or excuse me, when you're taking the income statement against the balance sheet? What are some of the common things that jump out to you, like, this isn't right, or something needs to be fixed?
Well, it's the personal expenses and the non-recurring expenses that aren't tracked. I haven't reconciled my bank statement in a year, and my books aren't up to date. It's again, in the cannabis business where I've done some work, and where I used to be in the animal hospital business, it's not recording all the business I did. The other area in the fertility business is some doctor owners pay themselves big salaries and show little profits. Some take little salaries and then have all the profits. Well, if you're selling to a corporate group, you're going to negotiate what you're getting paid for your work as a doctor post-closing. So that's one of the other things that you have to have an understanding of, and then recast your numbers to accurately reflect the past as if it was the future post-closing.
I want to talk more about the due diligence and the proctology exam, but I remember what I wanted to ask you about when we were talking about goals, and that had to do with earnout. So is it simply the case of one goal is, well, I'm just ready to leave the business, and one is, well, I'm going to stay? Is the case even if you're going to sell, is there still an earnout, and how long is that typically that I need to stay for 2 years or a year or 3 years, and how much of my buyout is tied to that earnout, and how much should I expect to get in cash, et cetera. Can you talk about earnout for a little bit?
Let me address that first from the buyer's perspective. If I'm buying a fertility practice, unless it's a large multi-doctor practice, a big part of the value is the producers. And if they're cashing out and leaving, it's worth less. So most buyers want one form or another of incentive. I call it a golden handcuff, to incentivize and ensure the continued performance of the drivers of the practice, whether it's the younger doctors who are taking over or the existing doctors. So and by the way, I have another one of my favorite expressions there. That's why there are 31 flavors at Baskin Robbins. Well, every roll-up group has a different way in which they like to do it. Do they want you to own part of your practice, or have a profit participation, or a percentage of the revenues above a base, or a percentage of the profits of a base? Or do you have stock in the parent company, or a little of all the above? You know, Ovation, you still own part of your lab and you own stock in the parent. One way or another, the practice is more valuable to the buyer if the seller still has an incentive to grow the practice and grow the practice profitably. For the buyer, the seller's standpoint, if the seller is selling and staying, he wants to participate fairly. Again, if my business is worth $60 million and I keep 40%, I sell, I take a partial cash out, and I keep 40%, I want that 40% to be more valuable later on. That was part of the story of every roll-up group. Ovation is the only one that's even partially worked where there's been a profitable partial cash out for others. Obviously, Integramed didn't work, and people's, including mine, and residual interest was worth zero. So you want the interest of the buyer and seller to be aligned one way or another, so that that business becomes more valuable. And when I eventually get my next cash out, it's for a higher number than today, because that's why I'm selling to you and letting you tell me what to do and putting your services in place and helping me grow, focus, do more. None of that matters if you're not improving my quality of life and or making my residual interest more valuable later on.
So for how long? Because owning 40% of a company that one built is different than owning 100% of the company that one built and having all of the say. And I suspect that this is where a lot of the problems could come from, is that, well, I don't own the whole thing anymore. But I'm still on the hook for listening to what the new leadership or the new ownership has to say. And I do have a financial stake in retaining this 40%. I guess, how long does it, like, when somebody sells partial, how long does that stay for?
Every scenario is unique. Depends on whether a doctor is 40 years old or 60, and what the goal is of the buyer. So again, every situation is different and unique. I mean, but understand that every private equity group, every buyout group, every roll-up group, no matter what they tell you, their goal is for them to either sell to somebody else at a higher price or go public. So
is there some sort of remaining buyout agreement? I don't even know if you would call that a buyout agreement within the new agreement, that, okay, if this isn't happening, the remaining partner has to sell their 40%, or are those typically in agreements?
There has to be some mechanism for an ultimate exit. When a doctor retires or dies, what happens? No different than in a group private practice, whether it's HRC or one of the other groups. You know, when someone's ready to leave, retire, or die, there has to be a mechanism to buy them out and for other people to get their equity.
do you have to have a mechanism for the evaluation in that agreement as
Yes.
well? So that, well, we say it's worth this. Well, I think we, grew the value to this, and now my 40% is worth Y when you're saying it's worth X. Is that evaluation in the agreement?
Absolutely. I mean, and that's no different in any kind of equity. This morning, I was on the phone with someone who was offering me equity to join a board of directors. And I said, well, if you're issuing me equity in every single year, how do we value it? So you have to mutually agree on a valuation methodology, whether it's you have an outside appraisal or it's the last transaction that raised money. But yes, there has to be, you have to button up every open issue so that both sides know what the future holds.
Okay. So you talked about the roll-ups that have happened in private equity. Can you first, how do you define a roll-up? Is it just any network consolidating? I guess consolidating in this instance is self-defined because they are moving more practices into their network or company of practices. Can you define roll-up, and then we'll talk about some of the things that people have to consider?
My understanding of roll up and roll out is a roll up is rolling in any business, is rolling up other businesses in the same industry. A roll out is a strategy which could be part of a roll up where you're opening de novo locations. So you might have a roll up rolling out satellites. You might have, there have been some models out there that open new locations, Kind Body, which is opening new locations. That's a rollout, but I know they also may be buying practices. So that is a roll up, and it happens. There've been roll ups in the veterinary industry, all over healthcare. Now in the cannabis industry, businesses are being rolled up.
So what are some of the considerations that not just fertility practices, but any company in the fertility field should consider if they're going to be if they're being approached by a larger organization that wants to roll them up into their portfolio?
So if I'm the seller, it starts with, what are my goals? Am I looking to cash out and leave? Do I want to stay 3 years or 5 years? This Oregon transaction that recently closed, they were looking to be part of a bigger group and have access to resources and have a partial cash out. But it's not, this is a very important point, it's not just the price and the terms. If you're going to be there the morning after operating your practice that you built and you've run, but now somebody else has bought you and owns you, you have to understand that they've now bought the right to make some decisions, to have veto power, to insist that you do certain things certain ways. And once you get past price and terms, what the relationship is going to be like the morning after. What are you going to insist that I do? What am I not going to do? What's your strategy for providing value added to my practice? Become as important, if not more important, than, thank you, you valued my practice at 60 million, I'll take my check and go home. And this industry, unfortunately, to date is littered with not overly successful roll-up strategies that have had ultimate exits.
But why?
There are a lot of new groups coming in. I'll address that in a second. There are a lot of new groups coming in. There's a lot of private equity money saying, wow, this industry is growing. Let's do here what we did in other industries. You ask, why hasn't it worked? I'll give you my personal opinion. The driving force of these practices, the doctors, whether it's in the animal hospital industry where I used to be, or the fertility industry, or other industries. And when you buy a practice that is entrepreneurial and self-owned, you're immediately, no matter what anybody says, de-incentivizing partially the driver of the business. That's part one. Part two is the roll-up only makes sense if the roll-up group creates economies of scale. Can we purchase cheaper? Can we negotiate third-party payer contracts? Can we do things that manage for you, your practice, better and or less expensively than you can as an owner operator? And to date, I don't want to talk specifics. To date, I don't believe there are many real success stories of people look in the mirror. Now, there are unbelievably fabulous practices like Shady Grove and others, Boston IVF and others, and CNY and Hunting HRC, that within their own group have expanded, have centralized certain services, have provided value added to their doctor partners. But when you start getting 5, 10, 15, 20 of them across multiple states that aren't born within a central strategy, name me one that's worked in the long term.
I don't know that I can yet, but I would suppose maybe the jury's still out. And I suppose if we had some of them on, they would say that it is working right now. And so
the jury's out, and I hope that there are some success stories, because I think that if you can bill better, if you can do the accounting better, if you can centralize buying, if you can do that for a solo practitioner and let them focus on running their location in the practice of medicine, it does create value for that practice. So in theory, it should work.
it sounds like you got a strong point of view on this, and I'm wondering, why haven't they been able to improve the economies of scale? You said that's one of the things that they have to do is their value proposition. And I don't know that this is true in the fertility field, but I did observe something back. My first job out of college, Richard, was selling radio ads. Just here's the phone book, kid, go slang some radio ads, 100% commission. I did that for 5 years in my early and mid 20s. And I noticed that it wasn't the McDonald's and the Verizons and the Geicos that got the deals, because if the large companies, Citadel, Clear Channel, Cumulus, Entercom, gave those companies deals, that would just obliterate their revenue. It was the additional people that got, it was, you know, your local driving school, your local jeweler, the scrap dealer. Those were the people that I could cut I could sell $5 in 08, 09 during the recession. It's a particularly egregious example, but I could sell, you know, things that should have been a $200 spot for $30. And I could sell the evening spots for $5 a piece and give away the overnight spots and all of that type of thing. And so I don't know that that's happening in the fertility field. So one question is it? Because
well, let me double back, because I need to amplify. At the end of the day, the corporate group needs to be able to generate value above and beyond the cost of its infrastructure. So, and I remember back when I was in the animal hospital business and we had 15 locations, the cost of getting up to 15 of a corporate infrastructure was very high. When you went from 15 to 30, you didn't need a lot of incremental infrastructure. So you have to have enough infrastructure to provide value added, to pay for that infrastructure and create value for the practices. Otherwise, you're just adding overhead that doesn't create value. The other side of the equation, and I recently worked with a solo practice that was minority owned by a doctor that was part of a roll-up group, where the question was, are the fees we're paying to the roll-up group worth the services we're getting? And the answer was no. Now, we have to replace some of those services, but they were doing billing collections, they were doing accounting, they were running the call center, and the doctor, right or wrong, thought that she could do it better, less expensively for herself. If that's the case, then the roll-up fails. But if the roll-up can provide those services more efficiently, less expensively than the practice can, and add value to the practice in a way that creates incremental value above the cost of that corporate infrastructure. I mean, Integramed drowned under its corporate infrastructure, among other reasons why Integramed failed.
So is it because, is it sometimes because there's redundancy, or is it simply because the inefficiency and expense? I could be doing this myself more cheaply or cheaper and more easily.
Again, at the end of the day, if you choose to outsource something in your business to a third party, it's got to be less expensive than what you're doing, free you up to do other things, which will add value more than the cost, or it's not worth doing. So if a fertility doctor can let somebody else manage his billing and accounting, and it frees he or she up, and the cost of having a third party doing it is less than having your own person doing it, well, then it may be worth it. But if not, there's no value added, because at the end of the day, it has to create $1 more value than the cost of doing it.
You mentioned that Integramed was kind of the pinnacle example of all of this. What are things that people should be looking for to make sure that they're not in a similar situation right now? Or, if you could have gone back in time 3 years or however long, I suppose, to have people look out for things that happened in that situation, what would you advise people that could be in a similar situation right now?
I'll give you an example in another industry. Years ago, when I was in the animal hospital industry, there was a group that had raised money at what I call stupid valuations, based on their promise of, we're going to buy 100 hospitals and we're going to add value to them, blah, blah, blah. And they wanted us to sell our group to them for a combination of cash and stock in their business. And they were going to pay us an artificially high valuation, but most of the proceeds we were going to receive was in their stock that was artificially inflated. So my partner then used to say, what makes us think that the stock we're getting at 15 times earnings is going to be worth that 5 years down the road? It doesn't make sense. Now, sometimes fundamentals don't matter, but fundamentally, if you're taking highly inflated stock in whatever business, and then the other is you have to believe in the strategy of the buyer, that they'll be successful. Otherwise, again, my partners and I took 7 figures of stock in Integramed. It ended up being worth 0. Had we gone back, if we didn't believe their model, if we didn't believe that they were going to be successful, why would you make a bet in them by taking their artificially inflated stock? So you got to believe who you're getting in bed with. Again, as I said earlier, especially if you're going to wake up the morning after and have to work with them.
When you're talking about, in this case, you're talking about inflated stock, but previously you were talking about the multiple of EBITDA that sometimes people are selling at. You used the example of 12. And 2 or 3 years ago, I was with one of my earlier clients, and I told them that some people are selling at 12 times EBITDA. And they said, no, that's not true, Griffin. They did not believe me. I said, it's absolutely true. I'm not saying it's true for everybody. The only times I've seen that high is through like very large groups selling to strategic buyers and, and having an established brand and clearly a system in place. But I think 4 is like the lowest I've ever seen. What's common nowadays?
Well, the market's gotten hot again because there are groups that have emerged with private equity backing that believe that, again, they can buy. So big groups that have a brand, that have multiple doctors, seem to be selling at double-digit multiples in some combination of cash, stock, earnouts, notes. But again, if you're a 1 doctor or 2 doctor practice, you're not as worth as much to the buyer. So those multiples can be 4 or less. Because again, if you're the buyer and you're buying a 1 doctor practice, you're taking an enormous risk. And that's why when I work with smaller practices that are thinking about exiting, well, you need to get multiple doctors, you need to open satellites, you need to buy people, you need to get bigger so that you're more valuable and perceived as more valuable to the next roll-up group that wants to come in your market and expand their market share.
Yeah. I want to do a whole episode on a topic that I think where a lot of upside is if there is a single doc group. I actually think that's one of the areas where somebody coming out of fellowship or a young associate doc that is either leaving academic practice or they were at somewhere else for 2 years, that can make sense for them if it's done right, because if that younger doc can bring in, that younger doc is in a better position to recruit other younger docs, and they have more time to do it. And so somebody vehemently disagreed with me when I was talking about this with them at MRSI. So I want to know if you disagree. They think there's too much risk in that. But I see huge upside.
If you find the right guy, I recently worked last year with a doctor in the Southeast, great practitioner, great practice. He's getting older. He's a solo doctor. He had a young doctor working for him. And to sell that doctor equity on the cheap may seem like you're giving it away, but 2-3 years from now, when he's ready to sell or retire, his practice is significantly more valuable because it's a multi-doctor practice that's reduced the risk. You and I have a friend in Florida we almost did business with a couple of years ago. In the last year, he's hired 2 doctors. He's opened satellites. He's made himself, instead of being worth 3 to 4 times, he's worth 6 to 7 or 8 times now when he's ready to cash out.
So, okay. So we're looking at this, if you could be looking at under 4 if you're a single doc group, and if you don't have a brand and you don't have things in order. If you do have a really robust brand, you have a lot of docs, you're talking well in the double digits of multiple. So I'm still curious, like, do you think my economies of scale hypothesis applies to the fertility field, i.e. giving the local businesses the deals, but less so to the McDonald's and the Geico? Is that one of the things that's hindering economies of scale? I don't know that this is happening at all in the fertility field, but I do see when I look at people in the industry side's target list, their target lists are all the same. It's these independent groups that still have multiple doctors that are still the biggest in their market, if it's a mid market, or at least the third biggest in a large market. Like, these are the ones that everybody is courting. Right. And so it seems to me like they would have, more purchase power, but I could be wrong.
Well, first of all, I want to comment about that. The law of supply and demand is such that if there are a handful of roll-up groups with a bunch of private equity money saying we need to go after this industry, that drives up multiples, because the law of supply and demand is that there are multiple companies bidding on the same handful of larger independent practices, which is why multiples are escalating now. And I don't think most of these practices in the long run are worth 10 to 12 times. So I would say it's a great time to be a seller. There are some economies of scale. There theoretically should be some efficiencies of consolidation. I've seen aspects of it work. But again, that doesn't necessarily mean that a smart solo practitioner can't negotiate the same deals, but you only have so many hours in the day. It's why practices hire practice managers, because that way the doctor can go back and practice medicine, deal with the patients and staff, and leave someone else to do what they do better, if they can do it better and if they can do it less expensively than the value they're creating. If it costs $2 to make 1, it's not worth it. But if it costs $2 to create 5, well, then it's worth it.
What about, I guess, if you're, in your early 40s and you own maybe half of a group or a third of a group, and you've got 1 or 2 partners, and then there's a young associate doc in there. I guess I asked you a little bit about the long-term hold strategy, and I briefly read a paper from HBR Yale's paper about that. Holding a whole long-term hold strategy is more profitable in the long run. I was going to read it to prepare for this. I didn't, Richard. I'm sorry. So when is that the more viable option, if it ever is, to just say, you know what, I'm going to own this thing for outright. I'm going to slowly increase the value and be 100% or majority equity owner.
There's no one right answer. But if I'm a 35 to 40-year-old physician in this industry or the animal hospital industry, another industry, and I believe in myself and I believe in growing the practice and I have the wherewithal to do it, unless I'm lacking something that a corporate group can give me, or I want to hedge my bet, why would I sell now? And, if you've convinced me that I should sell and the residual interest is going to be worth much more 3 years out. I'll answer the question by telling you a story. Years and years and years ago, when I was buying animal hospitals, I met this guy in Westchester who had the largest animal hospital in Westchester. He was making a ton of money. And frankly, he was underreporting about $1 million a year. So he was really making a ton of money. And he said, why would I sell my practice now at 5 times my earnings, even if I add back the cash, when I'm 40 years old? And I said, there's no reason for you to, until you're ready to retire, die, or you told me you eventually want to move to Arizona with your girlfriend and become a professional illustrator. And he went, you're right. Thank you for being honest with me. 2 years later, he called me and said, I'm ready to go. So, there was no reason for him to sell. He had plenty of money. He had plenty of growth opportunity. There was nothing that anybody could provide him that would add more value. Now, if someone comes in and says, I'll buy you at 15 times your earnings, that means it would take 15 years for you to earn enough to be equal. It actually does come down to partially a mathematical equation. And then, our friend in Texas who sold his software company reached a point where valuations were so high and he needed management help that it made sense. But until it made sense, it didn't.
Do you want to talk about some of the principles where you've done the deal and then you find out it didn't make sense and now you're unrolling up?
Oh boy, I know we've only got a few minutes. There are a lot of cases where the roll-up group didn't perform the way it said it was going to perform, and all those things I talked about didn't make sense. And especially for smaller practices where it doesn't make sense for the roll-up group to have a one doctor practice, people have cut the umbilical cord and uncoupled. The complexity there is if the corporate group has been doing your billing, your collections, your accounting, your new patient generation, doing all kinds of things for you, you better be prepared to take that back in and manage it yourself and not disrupt you doing what Stephen Covey calls keep the most important thing, and practicing medicine and running your practice. There have been lots of examples of where it's done, and it is because the corporate group didn't live up to the promises in the eyes of the seller. They didn't get me more doctors. They didn't grow me. The services they're providing aren't worth what I'm paying for it. I can't get anything done. So cut the umbilical cord. Let me do it myself.
Richard, this interview has been so much value for the audience. I think they're going to get a ton of value. I want to do a live event with you in 2022 where people can jump on and ask questions. Are you open to that?
I'd love to. You can tell I've been in this industry since 2001. I have a passion and a personal interest in the industry. I've got lots of friends in the industry. This is an area where if I can answer questions and help doctors through these different processes, I'd love to help.
There are some episodes that I go back and listen to because it's like I need to get all of that information. I can already tell that I'm going to be in early 2022 at the gym listening to this episode. So hello, future Griff, while you're listening to this. Richard, how would you want to conclude about the topic of selling a company in the fertility field, whether it's a practice or not, whether it's a pharmacy or an EMR company or a lab manufacturer? How would you want to conclude?
Prepare for the process and make sure you have the resources to go through it, to understand what you're getting into, and to live with what you're going to face the morning after.
Richard Groberg, thanks so much for coming on Inside Reproductive Health. We'll link to the places where you can find Richard. And where are some of those places, Richard? We'll link to your LinkedIn in the show notes. Where can people get a hold of you?
Through my LinkedIn. is the easiest place.
Connect
Or,
with,
Richard Groberg at outlook.com.
connect with Richard. And Richard, thanks so much for coming on Inside Reproductive Health.
Thank you. Thank you, Griff. I really enjoyed it.